1. What does no arbitrage mean? The basic idea of horse trading is to buy a nag cheap and unload it on someone else for a profit. An analog of horse trading occurs in financial markets, where it's called arbitrage. The French word sounds more respectable than the Germanic phrase, especially to academics and bankers. The idea of arbitrage is simple. If gold sells for $1,001 in Dubai and for $989 in New York, then traders should tend to sell gold short in Dubai and simultaneously buy it in New York, assuming that transaction costs and taxes are less than the total gain. This brings us to 2 points. Trading is often performed by using some fraction of borrowed money. In the 1. For a lively description of the bond market in the time of the early days of derivatives, deregulation, and computerization on Wall Street, see Liar's Poker by the ex-bond salesman Lewis. Stock market, that's called margin trading and may be highly leveraged. Short selling means borrowing someone else's shares for sale for a fee, and then replacing the shares on or before the expiration date for the sell order. A basic assumption in standard finance theory is that arbitrage opportunities are expected to disappear very quickly because there are many hungry and competent professional traders looking systematically for profits. Such traders are normally assumed to be posed to take advantage of any opportunity that presents itself. This leads to the so-called no-arbitrage argument, the so-called law of one price. The idea is that arbitrage occurs on a very short time scale, and on longer time scales equivalent assets will then tend to have more or less the same ask price in different markets. Arbitrage arguments are also applied to entirely different assets, like Motorola and Intel. Deciding what is an equivalent asset here is like comparing apples with oranges and can be dangerous because there is no falsifiable basis for equivalence. One must also be careful not to confuse a no-arbitrage condition with the entirely different condition of market equilibrium. For example, in Nakamura the no-arbitrage condition is assumed to represent Adam Smith's invisible hand. But consider two geographically separated markets with different prices for the same asset, say Intel. Via arbitrage the price may be lowered in one market and raised in the other, but even if the prices are the same in both markets, a positive excess demand will cause the price to increase as time goes on. Therefore, the absence of arbitrage opportunities does not imply either equilibrium or stability. By Adam Smith's invisible hand we mean market stability, or an asymptotically stationary market. The invisible hand is a synonym for an unspecified mechanism that moves prices toward a statistical equilibrium distribution. Arbitrage, carefully and precisely stated, is based on the comparison of spatially separated prices of the same asset at a single time t. To make clear that no arbitrage is not an equilibrium condition, we identify the correct analogy with an underlying symmetry and invariance principle. To see that a no-arbitrage condition doesn't imply vanishing total excess demand for an asset, consider two spatially separated markets with two different price distributions for the same asset. If enough traders go long in one market and short in the other, then the market price distributions may be brought into agreement. Even then, if there is positive excess demand for the asset, then the average price of the asset will continue increasing with time, so that there is no equilibrium. So, markets that are far from equilibrium can satisfy the no-arbitrage condition. Here, econophysicists have the advantage over economists. We understand the difference between time translational invariance on the one hand, and spatial translational rotational invariance on the other. In particular, continuous symmetries are intimately connected with conservation laws. In order to understand the geometric meaning of the no-arbitrage condition, consider a spatial distribution of markets with different price distributions at each location, that is, the stock market has different prices in New York, Tokyo, Johannesburg, Frankfurt, London, and Moscow. That is, the price distribution GPXT depends on price P, market location X, and time t. It is now easy to formulate the no-arbitrage condition in the language of statistical physics. The no-arbitrage condition means spatial homogeneity and isotropy of the price distribution. In the ridiculously oversimplified case of a uniform market distribution over the globe, no arbitrage would be analogous to rotational invariance of the price distribution, and to two-dimensional translational invariance locally in any tangent plane. The price distribution is not required to be stationary, so market equilibrium, market clearing, is not achieved merely by the lack of arbitrage opportunities. Given this, how can we define the underlying value of an asset? The terms overpriced and underpriced are often heard and read in the financial news. But to determine whether an asset is overpriced or underpriced, we would need a notion of value. Do paper assets like money or stocks really admit an observable intrinsic or fundamental value, or any useful notion of value other than the current market price? 4.2 Non-falsifiable notions of value. A debt of $1 owed today is worth less to the lender if payment is deferred for a year. If the annual bank interest rate is, then $1 promised to be paid now but paid instead after a year is worth only $1, where PV is present value and FV is future value. In finance texts, this is called the time value of money, for discrete time intervals. With interest rate for each interval, we have pages. This is also called discounting, in continuous time. So that present value is R. 82. Introduction to Financial Economics. The time value of money is determined by the ratio of two prices at two different times. Consider either money or any other asset, like a stock or a house. Is there an underlying true value of the asset, a fundamental price at a single time t? The answer is Jane. First, even in standard economics thinking, the value of an asset is not a uniquely defined idea. There are at least 5 different definitions of value in finance theory. The first is book value. The second uses the replacement price of a firm. These first 2 definitions are respected by market fundamentalists, and can apparently be useful, judging from Warren Buffett's successes. But it's rare that market prices for companies with good future prospects fall to book value, although the writer knew one such case in 1974, and by 1975 the price had quadrupled. Instead, we will concentrate on the standard ideas of value from finance theory, ideas not used by successful traders. A still popular idea among some theorists is the old idea of dividends and returns discounted infinitely into the future for a financial asset like a stock or bond. This reminds us vaguely of the neoclassical condition of infinite foresight on the part of agents. The fourth idea of valuation, due to Modigliani and Miller, is somewhat more realistic and is discussed in Part 4.4 below. The idea of dividends and returns discounted infinitely into the future is not falsifiable because it makes impossible demands on human knowledge. Here's the formal definition. Starting with the total return given by the gain RT due to price increase with no dividend paid in a time interval, and using the small returns approximation, we have a quarter ln dt equals dt or dt TDT TDT, but paying a dividend D at the end of a quarter reduces the stock price, so that for the TH quarter, a quarter DTT